Good afternoon, everybody, and welcome to the Chartered Accountants Ireland London Society Cryptocurrency webinar. My name is Peter Keenan-Gavigan, and I'm the chair of the London Society, and it's my absolute pleasure to welcome members from around the globe to this session. I can see from the registration list we have members in Australia, the US, all over Europe, and of course the UK and Ireland. This session is being recorded, so if you do miss some of it, please do look at our website next week, where all of our previous sessions are also listed. And if you want to ask a question during the session, then there's a Q&A box which will be monitored during the session, and we will try and get to as many questions as we can. This, as we know, is only a 1 hour session, so we'll not get into everything. There will be some further resources supplied with the obligatory email questionnaire after the session. So for those of you who have been to our sessions before, you'll know roughly what to expect in terms of format, but there's a few more events just to flag before I hand over to our moderator today. On the 5th of March, we have our International Women's Day event, some fabulous panels from the world of sport, education and diversity and inclusion. On the 22nd of April, we have our Treasury of the Future event. And on the 13th of May, we have our Chartered Accountant and the Gig Economy events that will coincide with our AGM. That's not to forget our monthly speed networking event, Coffee Roulette, second Tuesday of the month. So for details of all of these events and more, please look at our website and our social media channels. Just a few thank yous before I hand over to Angela. So all of our panel are given their time freely and their insights, which is greatly appreciated. So Angela, Craig, Marcus and Alex, thank you so much for sharing your insights today. And of course to our regional events executive, Denise Jones, who looks after us and makes sure everything happens on time and as it should be. When we were planning our events for the year, we had no idea that cryptocurrencies would be as volatile and as spontaneous and insightful as it is this past couple of months. So I think we're very fortunate with our time, but we always want to know what's coming on the horizon. So please do let us know if there's other events that you want us to look at. It's now my absolute pleasure to introduce Angela Foyle, partner in BDO UK, chairperson of the CCAB Economic Crime Panel, and chairperson of the Accountancy Europe AML Working Group. Angela, over to you. Thank you.
Thank you very much, Peter, for that introduction, and welcome everybody to this panel discussion on cryptocurrencies. As Peter's already mentioned, it's a very timely discussion given the recent record-breaking increase in the value of Bitcoin, but not just that, the increased regulatory interest in crypto assets, both from the FCA in the UK and also in the US and other jurisdictions. We have actually deliberately named this event, cryptocurrencies, what have you got to lose? New products, same questions, because it can be when you're dealing with something where people talk about blockchain, where they talk about crypto assets, virtual assets, digital wallets and other terms that we're not necessarily familiar with in our day-to-day lives, to get lost down the rabbit hole of trying to understand that rather than the questions that we should be asking when faced with any product, with any business that we're dealing with. So we should be asking ourselves the same questions. We have an excellent panel of speakers, and we have very limited time on a subject that I know that there's a great deal of interest in. So without further ado, I'd like to introduce the panel. Craig Gleeson has very kindly given his time up. He's the lead expert on the use of cryptocurrency and illicit finance for the National Economic Crime Centre, which is part of the National Crime Agency. In the last 6 years, he's developed intelligence and has been advising operational activity in the NCA to target those who are carrying out high harm offences, both in card fraud, dark web, both in the UK and internationally. He has contributed to both the National Crime Agency and government assessment products, risk assessment products, as well as the Financial Action Task Force content on crypto. So I'll also introduce each of the other speakers as they speak, but I was going to hand over to Craig to make a few introductory remarks.
Hi everyone. Firstly, thank you for inviting me to be part of this. Cryptocurrency is a fascinating topic, and I'm sure we can easily talk for hours and hours on this myself. I've been working in crypto for certainly the past couple of years. Fully, I've been encountering it during various other strands of work that I've been doing previously. the way that it has moved in leaps and bounds over the past sort of 18 months to 2 years is staggering. The example of that certainly can be seen with the rise of price of Bitcoin over the past few months, as Angela said, hitting record amounts. One thing that we have discovered, though, is that criminals are using this to launder their proceeds of crime. It's pretty much part and parcel with most organized crime groups. It's far more advanced than perhaps we had originally anticipated. As law enforcement, it's our job to respond to that, which we are improving our coordination, our fight against it. And certainly the fact that this year has seen regulation from the FCA come into full effect will no doubt help to tidy up and legitimize cryptocurrency usage, crypto asset usage. Also, obviously, as with any other commodity, fraud is rife in this area as well. I'll talk a bit more about it later on, but as with any other commodity, as soon as it becomes popular, criminals like to jump on it and start trying to entice people to part with money, perhaps illegitimately. But again, regulation will hopefully assist with that. Certainly, UK government, UK PLC, we are working together, probably better than we have at any previous point. Yeah, cryptocurrency usage remains top agenda for most law enforcement agencies at the moment.
Thank you very much, Craig. And now I'm going to introduce Marcus Peckham, who has joined us from the Barclays Financial Crime Team. He spent the last 20 years as an anti-money laundering advisory specialist who is looking at the critical and emerging financial crime themes and threats, and working on policies and standards, both internally and externally in Barclays. So he has developed specialist knowledge in particular areas, which include both trade-based money laundering, crypto assets, and blockchain technologies. So Marcus, if you'd like to just make some introductory comments, that would be great. Thank you.
Yeah, thank you, Angela. Thank you, Peter, and thank you to the CIA. Yeah, crypto, it's something that kind of came on the horizon, certainly from our perspective, 2012 and onwards, when we started getting inquiries from businesses, individuals, etc., asking what the simple appetite was for banking, customers and clients that were involved in that sector. And it's been largely through kind of self-education, self-awareness, reaching out to industry bodies that were around at the time, and kind of just building up that knowledge and expertise, really, to understand really at the outset, well, what's going on? What does this all mean? And obviously, more importantly, what does this mean to the financial sector? What does this mean from a financial crime, money laundering, terrorist funding, or terrorist financing perspective as well? So certainly over the last 7, 8 years, 9 years or so, we've seen an incredible kind of sea change in both the attitude and appetite for crypto across various communities. It's had its peaks and it's had its troughs, and we've certainly seen interest kind of evaporate as well to some degree. And we saw obviously things like Bitcoin certainly come to prominence in certainly the price hikes that we saw a couple of years ago, and obviously those have even been overtaken with what we've seen in the first few months of this year in terms of the price of Bitcoin. And that again has kind of fueled that interest again across all parties as to, well, what else can we be doing? Where are the opportunities? And not only where are the opportunities, but also, are there any new risks that we ought to be aware of when we consider the financial crime implications? And obviously, we pay very close to what we see from industry, what we see from law enforcement, such as the NCA's annual financial crime review, as well as obviously working with the likes of Chainalysis, Elliptic, and others to kind of get their understanding and insight into what's going on into the great crypto ecosystem. and what that means to us, and how also we can adopt technology and adapt that technology to, you know, financial institutions, to the banking world, and how we can then look, as I said, for those opportunities perhaps where you know, we can perhaps remove some of those smoke screens and some of those barriers, but we are still very much in a very cautionary state. And you know, I think this year may well be a significant and defining year for crypto as a whole.
Thank you for that, Marcus. And finally, but not least, Alex Morton, who is a Director of Audit and Assurance at Deloitte LLP in the UK, who has worked in Deloitte on a number of its largest financial service audits. His most recent experience has been to deal with complex financial services businesses, particularly in relation to those who are holding and dealing in digital assets. So Alex, if you'd like to make a couple of introductory remarks.
Absolutely. Thanks, Angela, and thanks to Chartered Accountants Ireland for inviting me today. Looking at this from an audit and assurance lens, when I read the title of this, the immediate thing that stood out to me was, if you buy a Bitcoin, if you can afford that much or a fraction of a Bitcoin, how do you know that that is safe and you can rely on the custody? Ultimately, from an assurance standpoint, the question we've been tackling for a few years now is, one of the great advantages of blockchain technology is the transparency it gives, and the fact that you have an immutable source and you can see every transaction on the blockchain that is there for everyone to see with the right Internet Explorer tools. As soon as you involve an exchange in that transparency disappears completely, and the pooling of assets by exchanges really gives a challenge to both the users of those exchanges and anyone trying to provide assurance over whether sufficient assets exist. For those of you that have been looking at this for a few years, you may have seen the Quadriga example in the press a few years ago, where the mysterious disappearance of the CEO meant that a lot of users were locked out of the exchange and hence their underlying assets. So when I think about this question, I really think about, as regulation starts to evolve, you know, we've seen great strides from the FCA in recent years around anti-money laundering controls, but regulation is still variable on a global basis. So as regulation evolves and as Bitcoin and other digital asset custody becomes more institutionalized, what assurance should you be looking for from an exchange that you're dealing with to make sure that your assets are safe at all times, similar to the way that you would if it was a cash holding?
Great, thank you very much. And I think if all of the panelists can put their cameras on now, so while we start the discussion. So the way that we propose to hold this is, we've got a case study prepared, which is a very straightforward case study. And because I don't think it's been circulated, I'll just give the key facts. We've got a lady called Jo Bloggs, who's running a family jewellers, which is based in an affluent suburb of London. It deals both in manufacturing of bespoke jewellery as well as retail sales. Jo's built up sizable reserves because she's had a very successful trading period recently. So she must be one of the few retail businesses who has quite recently, to be honest, but that's just a comment. But she wants to look for both novel but safe ways to use her business capital wisely. The thing is, she's heard about other businesses who are willing to use Bitcoin to both as a form of payment, and is interested in finding out a bit more about that. But she's also interested potentially in investing in Bitcoin herself. She doesn't really want to lose out on any possible gains, but she's not entirely sure about what the consequences might be. So she approaches her local chartered accountancy firm, the firm that she's dealt with for many years, which is a medium-sized practice. It's got 5 partners and 65 members of staff. It is part of an an international network of independent firms, but they haven't so far in the UK advised clients on cryptocurrencies. But they don't really want to be left behind and seen as a bunch of fuddy-duddies. So they really would like to go and have a look at whether this is something they could advise on, using both the resources they have themselves as well as the network. So that's the background that we're looking at. And what we want to try and do is, through discussion, is look through the kind of questions that we might want to ask and some of the red flags. So I'm going to sort of put it through to Craig to start off with, which is, there are two things that Joe wants to do here. One is look at crypto as an investment, and then the second is to perhaps take it, to receive it in payment. I'd like to focus first on the payment aspect of it. From a national crime agency and law enforcement perspective, what would be the concerns that you would want her to consider?
So first and foremost, it's always important to remember that the use of cryptocurrency is not illegal. It's perfectly legitimate to buy and sell commodities using it. However, as mentioned before, the use of cryptocurrency is commonly associated with money laundering. Rightly or wrongly, it has that stigma attached to it. There are obviously risks associated with it. One of the main ones is that it's pseudo-anonymous in nature. The transactions can be obfuscated. So there are services that are out there, such as mixers, that will allow the user to essentially put their cryptocurrency into a black hole. It comes out not linked to any sort of previous route that the currency was traveling on. There are also what's known as privacy coins out there. These are coins that are completely anonymous. So I say Bitcoin is pseudo-anonymous. It has a publicly viewable blockchain. Every transaction is on that. Obviously, big mixers can obscure that a little bit, but something like Monero is completely private. Therefore, one of the main things anyone looking to receive cryptocurrency, they need to be aware of where it's coming from in the best possible way. There needs to be a degree of due diligence put in place in order to try and find out that the source of the funds is as legitimate as it can be. And if you do happen to identify the use of Monero or something like that, again, it's important to note it's not illegal in itself, but it does pose a massive red flag. As with anything else, the questions that would need to be asked: why are you trying to hide these funds? So ultimately, a lot of this would come down to sort of KYC implementation put on by the receiving party to a degree. They can know as much about what the customer, where the money's coming from, or where the crypto is coming from, sorry. Hopefully that can mitigate some of the issues that we face.
Marcus, I mean, from a banking perspective, I mean, what would you feel, what would your appetite be for somebody who's in a high value dealing of jewelry who receives crypto?
Yeah, it's an interesting one, and one that we are familiar with from our own kind of firm's experience. And of course, as we probably ought to highlight here, when we associate new payment methods such as crypto and Bitcoin with businesses that tend to have that kind of tag of higher risk from a financial crime perspective, and certainly kind of high-end jewelry businesses, etc., do pose a certain risk in terms of turning dirty money into an asset which can otherwise be exchanged or sold on and liquidated elsewhere. So certainly when you have a combination of the two, it certainly kind of gets you into that kind of enhanced due diligence mode. And Craig obviously talked about the KYC element, understanding things like source of funds, etc. And for us, it's important the mechanisms by which a commercial enterprise would want to receive that crypto. So whether it would be directly, and they would hold it in their own kind of personal wallet, crypto wallet, or whether or not they're going to be more of an arm's length kind of recipient of crypto. So that's be using the services of something like Pay, which is a bespoke crypto merchant acquiring type business that effectively handles all the crypto on your behalf, and you only ever see kind of the fiat side, the fiat cash out, as it were, and therefore the risks are slightly reduced in terms of the flows that jewelry business would see coming into its bank account from those sales. And there are other options as well, through direct trading with crypto exchanges. And again, we look to the integrity of those exchanges. And I think it's probably fair to say that most of the big exchanges will have had some scrutinization by regulators, both here and in the US and elsewhere, at one point or another. And whilst that in itself isn't necessarily an exact kind of pointer as to whether or not any one exchange is better than the other, it is just something to be wary of. But also, as I said, as Craig said, crypto in itself isn't illegal. Dealing in crypto isn't illegal, and it has a little, it has got this kind of a little bit of a kind of dark web tag to it, and associated with things like the dark web, illicit trading in goods such as drugs, arms, etc. But as I said, if we have got a customer or client looking to accept crypto, number of questions that we would ask as to how they expect to actually, as I said, handle the actual underlying asset itself, whether that be directly or at arm's length. And on the kind of investment side, obviously I'm giving absolutely zero investment advice here at all. But on the investment side, obviously, we've seen just in the short few weeks of this year, the volatility of crypto, the volatility of Bitcoin in particular. And it only takes an individual such as Elon Musk to say, I think it's the best thing since sliced bread, and my company has plowed X million into the cryptocurrency. And that obviously had a significant influence on the price. And it only takes somebody else to say a negative comment for that price to soon come tumbling down. And also the regulators, certainly in the UK and elsewhere, have they've woken up to the fact that this does present to the retail sector a significant risk, and therefore the UK FCA have made it effectively effectively illegal, and have prohibited the sales of derivatives or exchange traded products in crypto to retail customers. So it does reduce somewhat the exposure, I think, to businesses such as the jewelry business that we're talking about here. But I think we will see probably an unwinding, perhaps, of some of the prohibitions, and perhaps some of the barriers that are there today in how individuals and businesses are able to interact with cryptocurrencies in the future. And as a payment method, I guess we wait and see what happens to the kind of the pure cryptocurrencies such as Bitcoin, Litecoin, Ethereum, etc., and whether or not there's more of a move towards things like stable coins as the kind of go-to settlement type mechanism in the crypto space and crypto ecosystem.
And I think that's something that I wanted to come on to a little bit with Alex, because we are talking about a business here where you have to record sort of revenues and profits, and therefore with something that is subject to wild price swings, there is liquidity at the moment, at least. But I sort of what would be the things that you'd be looking at if you were auditing this business, and what would you advise the chartered accountants to think about in this area when looking at Joe's business? And I'd like to come back, Marcus, afterwards to some of the points on investment, because I think there's probably some points Craig would want to make on that as well.
I'm obviously on the right wavelength, because liquidity is the third thing I wrote down when we were going through that case study. I think I'd echo all the same points on AML and KYC that Craig and Marcus read. From an auditing perspective and a business risk perspective, compliance with laws and regulations is becoming more and more a focus of audit firms, and this is an area where there really is added complexity, not just from potential customers, but Marcus started to talk about, as plug into that infrastructure other businesses that you might be dealing with as well. And we're not here to talk about that today, but businesses that have done ICOs, initial coin offerings as an example, there's real complexity there around AML and KYC. But yeah, liquidity I think is really key here. The valuation of Bitcoin or Ethereum or the more established cryptocurrencies is relatively simple. There's an active market out there, and at any point in time, it only takes a few clicks on Google to know what the price is. The real challenge is forecasting and knowing what that price might do in the future, and there's significant volatility. And clearly here, Jo is exposing her business to significant additional risk that she wasn't before if she starts to hold material cryptocurrency balances on her balance sheets. The second piece is that liquidity piece, that as she needs to liquidate her holdings going forward, clearly in this environment, and as Bitcoin is going up and there's real supply and demand, liquidating small amounts is not necessarily a challenge. But if we came across a crash in a price of a cryptocurrency that she was dealing in, I think it raises two really key questions for us. One is, would she be able to liquidate her holdings at all as needed? I think the answer to that, I think that's a fairly doomsday scenario of not being able to liquidate, but to be able to liquidate at a reasonable price, I think is a really key question. And so as she's doing her business planning and forecasting, I think that's one thing. And we would be looking to going concern from an audit perspective. How does that all fit in? And that has certainly been in the businesses that I've advised and audited in this sector. Liquidity has been one of the most significant risks that we've had. In terms of addressing that, the last thing I wrote down and underlined twice was controls. Often small businesses like this are not particularly well controlled, and from an audit perspective, we've been auditing most of the other balances on the balance sheet for hundreds of years, far beyond the start of my career, and we have well established processes to use a colloquialism, tick and bash through all of those balances on the balance sheet, and ultimately you can roll up your sleeves and pick a big sample and get happy with what sits there. The real challenge that digital assets raise is detailed testing is in virtually all cases not enough. That Jo would have to have all of the right controls within her business to satisfy us or whatever firm as their auditors, that the assets that they hold are both exist and are theirs, but also I suspect, I saw Marcus nodding, give their bankers comfort and anyone else that they're dealing with that they're dealing with this in the right way. And that is a real mindset change that we've seen real life businesses come unstuck with.
Well, I just point out we're getting lots of questions coming through, not all directly linked to some of the points that have been raised. There's one that's tax related. I'm slightly feeling vulnerable because I'm not sure that any of us are actually tax experts on crypto in this panel. And it's been a long time since I advised on tax, which was that is one of the big issues in relation to receiving payments in Bitcoin, the reporting of it. Does every transaction trigger a CGT event? And I don't know the answer to that. I don't know if anyone else knows the answer to that, because I think HMRC have issued a couple of papers in relation to the taxation of crypto, but it is that has been for some years ago, and I'm not sure that they've brought anything out since about 2016, 15 or 16. One thing I would say,
it's a really good question, and one that it's pretty much impossible to give a helpful answer to. In the UK, currently the tax follows the accounting, and the accounting, which I won't go into in detail, is not particularly helpful.
I was going to say that I think probably certainly for the receipts in a trading context, it will be trading, following the accounts essentially.
But the volatility in crypto assets that the business might hold Some of that will go through P&L, some of that will go through OCI, and the taxation, and whether you hold at cost or at fair value would have a big difference on when those tax liabilities are crystallized. However, in the US, and I'm not sure how far this has progressed, the move was certainly in certain states at least to treat crypto assets like financial instruments from a tax perspective, which puts you into a completely different realm. So I think the simple answer is, in the UK at the moment, for a business, it would not trigger a capital gains tax charge. The tax follows the accounting, but globally, it's different in every jurisdiction, and the level of thinking that the tax authorities have done everywhere is at different levels of progression.
I think sort of I can understand that, and I think that the second point is where we're coming into the investment elements of it, and I know there's quite a few questions coming through around various things. But on the investment element of it, I think there, if you're using it purely as an investment, you probably are into CGT, at least when you realize value. And the question is, at what point do you realize value? Is it at cashing out at fiat? Because typically it is only when you dispose of an asset that you would pay capital gains tax in the UK. So I think that's still something that's developing, but that would be how I would expect to see it. I want to come back to the investment aspect, because I think there's a few points that we probably should make and then pick up some of the questions that are coming through. I mean, I think, first of all, I think, and anyone can come in on this, how sensible is it in the current environment for someone who is relatively unsophisticated in this area to actually seek to use crypto as an investment? Is the first question. What should they be thinking about? The questions they should be asking. And I think the third one is, exactly what are the risks to an individual? Where might things go horribly wrong? So I don't know whether Craig wants to start with a couple of points there and then move on round.
Yeah, I'm happy to start with this. So in terms of whether someone should invest in cryptocurrency in Bitcoin at this moment in time, it's a decision that they would have to make, and I would argue they would have to make it having done a degree of research. And I think research is the important thing, as it would be in any sort of investment. You have to have at least some sort of understanding as to what it is you're investing in, particularly the risks associated with it. Any sort of legitimate article or piece of information associated with crypto will tell you it is volatile. Bitcoin can rise, Bitcoin can fall. So you have to acknowledge and accept those risks. That what can you lose? Well, you can lose everything you've invested, potentially. The other thing is to understand who it is you're going to invest with and put the research into that. As I've said, as has been said, crypto is now something, or people buying and selling crypto is now regulated in the UK. So any exchange, any investment firm that is offering crypto-related products should be registered with the Financial Conduct Authority. If they're not, then that should tell you what you need to know. Have a check of their register. If a firm does not appear, then you shouldn't be considering investing with them in the first place. Because, and this has happened more so this year, but it's been an ongoing issue. Fraudsters like to capitalize on people's lack of knowledge with cryptocurrency. Because you hear stories of people managing to make a fortune from this. Obviously, get rich quick, it catches a lot of people's attention. But most of the emails that you're likely to receive, if you're receiving something unsolicited in the first place, it's likely not to be legitimate. But it's always about doing the research. If you're going to invest with someone or purchase cryptocurrency from someone, first check the FCA register, then just do a Google search, see what other feedback is coming back. There are scams out there, particularly ones that are looking at investing in a new coin. So a big example of this would be OneCoin. It was a new coin that came on the block. was sold as a new coin. Next big thing, bigger than Bitcoin, it was a complete scam. There was no coin. The people behind it just wanted to get money from people and then do a runner with it. Again, check with the FCA whether the firm selling this is regulated.
I think, Craig, that sort of links into a question we've had 3 or 4 times coming through. And I think Alex is going to probably pick it up as well, which is how do you actually verify the existence of it? You've just mentioned OneCoin, where, for example, it was a complete scam and the individual behind it, a lady, has disappeared off the face of the earth as far as we can see. How do you actually, there's the FCA websites, what other kind of things? And please do also, Marcus and Alex, come in here. How do people actually ask the right questions here?
It is an interesting one, and as Craig has already highlighted, obviously the various scams that we've seen over the last few years, and let's also just kind of broaden the way in which people can trade crypto. It's not just by an exchange. There are so many other kind of platforms, peer-to-peer platforms out there as well as chat rooms, social media, which are by and large incredibly unregulated and very much kind of under the radar. And if somebody's tapping you up and saying, I've got X amount of whatever it might be to offload, are you interested, on a social media chat room or other kind of peer-to-peer platform, it's going to be very, very difficult to, at the time, verify the legitimacy of the Bitcoin that's been offloaded. Now, obviously, when you're dealing with an exchange, and similar, you'll by and large be relying on those exchanges to have sophisticated tools to track the provenance of cryptocurrencies across the blockchain, across the Bitcoin crypto ecosystem, and be able to identify if those Bitcoin or whatever have actually touched a wallet that has been hacked, for example. And we've seen many of those hacks over the last few years, going back, as I said, 6, 7, 8 years or so, produced significant numbers of Bitcoin being hacked from those wallets that are being held on exchanges. And so, you can still identify the provenance of those cryptocurrencies back to any illicit event, such as a wallet hack. And so that, to Craig's point earlier, it is about the integrity of the third party that you're actually going to be doing that investment through. And whilst, as I said, for the wider community or the retail sector, the use of derivatives, etc., isn't an option. There may be other kind of quasi-fund type investments which may not give you that direct exposure, but may give you some other means by which to benefit from a measured fluctuation and increase in value of a basket of cryptocurrencies, for example. But again, that's just again based on research. That's just again based on an individual's appetite for risk and an individual's ability to go out and source information. And there is absolutely bucket loads of information out there. And it is, unfortunately, sifting the good from the bad, ultimately, and aligning yourself to a good actor.
Which I think comes back to that thing, you're asking the same questions for a new product. Alex, there's quite a few questions which I think might be best put to you, which is, if you are buying an asset, first of all, how does a non-technical professional address the key aspects of existence and ownership? So if you're non-technical in this.
So I think I'm well placed to answer that as a non-technical person. So I think if I stick to exchanges, because otherwise we could be here for hours. As a business dealing with an exchange, I would be extremely reluctant to deal with an exchange that did not have a external service auditor report over its controls. I think enough exchanges have them now, and for me, going back to controls, by ownership, what we're talking about with the digital asset is essentially sole access to the private key in relation to that wallet. And when you deal with an exchange, you are handing the security of that private key over to that exchange. So I would want to know, as a technical person, does that exchange have the right, as a non-technical person, does that exchange have the right controls in place to manage my private key essentially as they should? Because in an exchange, you essentially have two different scenarios. You have private key segregation, where every single customer of that exchange has their assets held in a different wallet, and they can go onto the blockchain and see that holding at any point in time. You then have pooled assets, which clearly is much more difficult because your assets are pooled with everyone else. And if you go onto that blockchain address, you will just see a huge amount of Bitcoin that relates to everyone else's. But even where there's the segregation, you still have the risk that someone else has access to that private key as well. So it's not just the exchange that could move your assets, so someone else out there could as well. So for me, it's all about controls. And so if you're, unless you're going to engage chain analysis or someone else to do a huge amount of work on your behalf to go through and check these things in detail, I think these third-party assurance reports are going to become absolutely key, as they are for all holders of wealth, so investment managers and wealth managers at the moment.
I'm afraid, Alex, the next question probably is more aimed towards you as well, which is around if you're going to have, if you buy an asset using crypto, the question was, what currency should the asset be recognized in? I suspect it's actually what currency it might be denominated in, because if you buy it in crypto, but it's actually a dollar set of accounts, I would imagine you would value it in dollars, but I'll leave you to answer that. And the other...
Oh, sorry, go ahead.
No, please go ahead. And then the second point on it was, can you comment on whether there will be a need to modify audit reports if this becomes more common, accepting payments in crypto, given the valuation and liquidity issues that have been mentioned?
Yeah, so digital assets, there's fairly well-established accounting conventions now around digital assets, and they are held virtually in all cases. So underlying cryptocurrencies are held as intangible assets on a balance sheet. That gives two accounting challenges, really. One is there is a choice if you have a highly liquid asset such as Bitcoin as to whether you hold them at cost or whether you hold them at fair value. But then also gives a challenge to your income statement, because any upwards valuations in fair value will go through OCI, whereas any impairment will go through P&L. So you get an inevitable mismatch in the income statement in your company. That is where the accounting standards sit at the moment, and ultimately I think there is, over the next however many years, and depending on where we go from this point in time, I am sure that the standards will catch up to demonstrate this in a more useful way for the users of accounts, because at the moment there's a huge amount of narrative reporting that's needed to clearly explain what's going on. But clearly, digital assets as they stand today, and as we take Bitcoin as an example, they are not underpinned by a government, and so are not cash. And so you end up kind of dismissing a number of different options and getting to intangibles, although some of the derivatives that Mark has talked about are financial instruments. But ultimately you follow those accounting concepts as you go through, and they give fairly complex financial statement outputs. From an audit report perspective, look, these are all risks that we've talked about. We've talked about valuation, we've talked about liquidity. If I talk about valuation from a historical standpoint, from my perspective, with highly liquid assets, that does not give much of a challenge. You should be able to come up with a reasonable estimate of what your Bitcoin was worth at your year-end date. From a liquidity perspective, it's a risk, but it's not, it is possible to overcome. And I think that the most common modification we'd be likely to see would be an emphasis matter around a material uncertainty ongoing concern. That if you get to the point, and we've seen, I'm glad I wasn't the first to bring up Elon Musk, but we've seen already that Tesla's share price is now intrinsically connected to the valuation of Bitcoin. And depending on how much cryptocurrency you earn, the valuation and the viability of your business does become linked to the volatility of the underlying digital assets. And so that immediately brings into question going concern, because that is outside your control. And I think as mentioned, one tweet could send it in a direction that's not great for your business. And so that's what I probably expect to see going forward. But we, from the businesses that we've dealt with the right controls, with the right liquidity management, it doesn't have to be a problem. I don't think this is an absolutely fait accompli. I think it's risk that can be managed. It's just the risk needs to be acknowledged.
Thank you. I mean, actually, there's a really excellent question come in now, which I think I'll open up to whoever wants to take it first, which is, apart from accounting for cryptocurrencies, what other issues should accountants consider? For example, their technical expertise, environmental impact of Bitcoin, which I think is one of those that is quite an interesting one. I think that mining Bitcoin takes up as much power as the whole of that required by the island of Ireland, I believe. So there is an environmental impact on that. So who would like to come in on that one?
I'm happy to pick that up. I think from as Angela mentioned, I spend a lot of my time dealing with large listed financial institutions, and for listed businesses, climate risk is really at the forefront, and that is naturally going to filter down into private businesses as well. I think the acknowledgement of where we are as globally and as individual nations on that climate change agenda, and the inherent risk that creates in your business, I think that's a brilliant question, and I think that is something that's going to come more and more to the forefront. Whether it's that you trade oil or whether you deal in Bitcoin, I think that the recognition that the current status quo might not last forever is a fundamental viability risk for every single business. In terms of technical expertise, I think, having gone through an audit of a large global exchange, I think it's very similar in my mind to auditing a large bank. There is no individual auditor or professional that can do all of this start to finish. And the need for specialists throughout is absolutely vital. And however, I'd come back to what Angela said at the beginning. A number of these risks and a number of the solutions to these risks are often relatively simple, and it's very easy to get blinded by the cryptography and all of the complexity underpinning it. So I think there is still, that role for all of us as individuals to be able to acknowledge risk and do a bit of a stand back test. But absolutely, without the right technical expertise, none of this is really possible.
I think that links back into a point that both Craig and Marcus have been making about when you're actually looking at this, either to take on a client who's involved in crypto, or indeed to whether you consider making an investment in crypto. It's actually tapping into the technical knowledge and expertise that is already there. And I think one of the points that I'd like to come back to, and there's a couple of questions I'll come to as well, which is around the chartered accountancy firm, which hasn't previously had experience in this area. And what are the kind of things, I'll start with you, Marcus, around, you've mentioned some of them already, but they've been dealing with Jo for a number of years. She's suddenly going to potentially go into crypto. What should be the first things that come to their mind when thinking about that?
In terms of accepting crypto, as I said, as a means of payment, I guess first of all is to understand what percentage of their overall kind of turnover or their business activity they anticipate doing it in crypto, and also more importantly as well is the type of clients that they'll actually expect to be servicing through the selling of their jewelry and what have you. in exchange for that crypto as well. So again, those are certainly risk factors that we would be looking the client to understand and consider, and we would be considering that as well from an enhanced kind of due diligence perspective, because the profile of the clients that are paying for stuff in crypto may be entirely different to those that are paying it in traditional means through fiat currency.
So effectively, from your perspective, it's essential, and I suspect Craig might say the same thing. It's effectively at that point, your ongoing monitoring should kick in to re-look at the risk posed by Joe's business to that accountancy firm, but also presumably as well, asking her the questions to understand what it is that she's doing.
Absolutely, and it's a mantra of any kind of bank or financial institution to know your customer, to know your client, know your customer's nature of business, and also why they are using certain products, using certain mechanisms by which to do business, and that's fundamental around the kind of the broader know your customer, know your client criteria.
Brilliant, thank you. And I think, Craig, do you have anything to add to that, or?
No, I agree with what he said. I suppose the only additional thing is that in crypto, you have what's sort of known as the travel rule, which, albeit not necessarily in place here at the moment, is being considered, and that is essentially know your customer's customer. So that would have to put the onus on the business itself to know the customer a bit more on behalf of who they're banking with, which just extends the whole KYC and knowing where it's come from, and that ability to understand the source of the funds.
Brilliant, thank you. There's a very interesting question come up, which is, what are the implications for banks and other members of the regulated sector as central banks may consider starting to launch national cryptocurrencies? And I think we've had the Chinese have indicated they might be doing it, the Russians started dealing with this as well. And what might be the regulatory impact on banks in those circumstances, if anyone's got any views? Who wants to come in?
I don't mind kicking off. My knowledge is fairly limited, I think, other than I know what the kind of the alternatives are. You've got utility settlement coin, which is something that's been progressed over the last 2 or 3 years, and certainly central banks are looking at that as kind of an alternative and running as complementary, I think, more to the traditional way that payments are settled cross-border in the traditional kind of correspondent banking way. So it's not necessarily seeing this as an absolute alternative, is my understanding, but something that runs in parallel or complementary too. And using that technology, using the DLT, distributed ledger technology ecosystem, to provide additional means of liquidity, additional means of making those payments and settlement. So utility settlement coins, again, as I said, it's something that's been talked about, and I know that central banks and other bodies are quite desperate in some ways to kind of have this be rolled out sooner rather than later. Again, I would just not have a clue when we do see that coming on tap, shall we say. And then of course we've got stable coins as well. Stable coins, I think, are again an area which will gain momentum over the next year or two, and we'll see that perhaps being used more in the kind of, and it may be best suited to this type of business where they're looking to receive an alternative or provide alternative means of making payment for goods and services. So stable coins probably we'll see a little bit more traction for. Utility settlement coin, I think we've still probably got a little way to go. And again, there needs to be a huge consensus globally across central banks on what to use and how to use it as well. And I think by and large that's probably not necessarily quite there yet.
And I think in stablecoins, actually, the FCA have published a consultation or a discussion paper on that. Am I right?
But they have indeed, yeah. There's been various consultations issued, and certainly there was one at the beginning of this year on that as well. So all the banks, financial institutions, etc., have been reached out to input into that. And I know certainly, we're doing so at the current time. We work very closely and collaboratively with the regulators, with industry as well, in those kind of feedbacks and consultations.
Brilliant. Well, we've got about 5 minutes left, so we've got time, I think, for one question, which I think is a really interesting one, which is that there are a number apparently of cryptocurrencies which can now be mined on mobile phones. And the example given is PI. I'm afraid I'm not familiar with PI, so I don't know if anybody else is. And there was a question around data privacy on that. I don't know whether they mean mined or actually acquired or dealt with on a mobile phone, but around data privacy. Does anyone have any insight or knowledge or understanding of that they could comment? Or is it one of those questions?
You'd have to have a pretty powerful phone to do any crypto mining on it.
Well, that was my thought as well, because I have visions of these banks of computers required for mining, but whether it's using just the spare processing capacity as part of that link, I've got no idea. So it might be worth that, but I mean, I would have thought that if you are using something like that, you'd want to have some pretty tight controls, because if you're giving anyone access to spare capacity on your phone or any other device, then the chances are, and Craig, you'll be able to say this, that you could be opening yourself up to criminals.
Yes, yeah, definitely. It sounds like a massive risk. I know that aside from the big banks and warehouses for mining, you can be part of a mining pool, which is collective sort of people using individual computers around the world. Again, I can imagine it still requires a degree of power, but I'd be amazed if a phone could do. I assume with Pi, they're referring to a Raspberry Pi, which is, I think, a miniature sort of computer. Whether or not that's powerful enough to do the mining itself, I don't know. But yeah, I would be very wary of handing any control over to someone else. Cyber criminals are well versed in cryptocurrency and hacking. They've gone after exchanges. It would be no issue for them to go after individuals using phones and extract all kinds of unwanted information.
And also, there's been stories of computers being hacked with bots and what have you. That you don't know that your PC power is being used for crypto mining as well. So again, as part of a chain of smaller kind of PC computing power being used in the bigger sense. And certainly, I read stories quite frequently of computers being manipulated, home PCs, individual computers, etc., being manipulated in that way as part of kind of that chain of mining capacity that OCGs and the like, organised criminal gangs and the like, will tap into.
Yeah, so if you see that your power is slow, if the speed is slowed down, then you maybe need to do a security check. I'm conscious of the time because we've got less than 2 minutes left, and I have been asked if I would mention the next Chartered Accountants London Society event, which is on the 22nd of April, which is called the Treasury Function of the Future. And apparently it can be booked on the Chartered Accountants Ireland website now, which sounds quite a very interesting discussion. So having mentioned that, what I'd like to do for the last couple of minutes is just to thank everybody who has taken part, to thank them for their insights, to recognize the fact that actually crypto is such a huge area that it's really difficult to do anything other than touch on certain surface areas in an hour. But I think it's certainly one, if people are interested, we'd be happy to continue a conversation on another occasion, because there's everything from the technical aspects that Alex has covered, the anti-money laundering and regulatory aspects covered by Marcus, plus the very, very salutary messages that Craig has got around criminal activity, which I think that we will see continuing and increasing. We haven't even got on to the use of crypto in things like ransomware schemes and other things, which we could have touched on. But I would just like to thank everybody, and I've been asked if we would finish with a few price predictions. All I'm going to say to that is laugh. I'm terribly sorry about it, but actually, your guess is as good as mine. So thank you very much, everybody. And I don't know